Investors and traders, welcome to the channel Market Chart Pattern. Today is 5th of August 2024. Hope everyone is having a good day. We will be taking a look at the US markets. We'll be covering the US dollar. We'll be taking a look at the treasury markets through the eyes of the long bond futures, treasury notes, and the shorter term 2-year treasury note, and also treasury bill, excuse me. And we'll take a brief look at the gold market, and then we will take a deep dive into the stock indices. As always, this video is for educational purposes only, and it's not a financial advice. Just briefly, we are taking a look at the weekly chart of NASDAQ 100. It completed this big, massive one-to-one price projection ABCD pattern right at the 1.618 expansion of the BC swing, and we had the target of 20,750. The market met that target, and ever since completing that target, we have seen a pretty large pullback that happened in the market over the course of last 3 to 4 weeks. And important thing to note is that we have this trend line. It went right into it, and we'll take a deeper look at it a little bit later on in the presentation. Okay, so we move to the US dollar. Let's take a look at the US dollar. This is the weekly chart for the US dollar, and here our view was that 107 level is a pretty important high in the US dollar, and thus far it does prove to be correct analysis. There was a chance that when beginning of June, we had this for a few weeks, the market going up. There was a possibility that this level could in fact get challenged and the market could move actually higher. It did not happen, so I'm going to remove that, but that was an alternative scenario, not the preferred scenario, and it did not take place. Now what we are looking at is that now the week has just begun, of course. The key thing is that the past week the market took out the lows of 15th of July and of course the 3rd of June, which makes this trend line as a fulcrum, with the possibility of marking it actually moving lower into it. And we have this gap formation around here, so it's most likely to come to around 100 mark, maybe a little bit higher, 150. 100 spot 50, and so basically testing the bottom of this trading range. It has been a pretty large trading range, and the US dollar has been in this range for quite some time. It's our view, once the dollar is able to break below the 99 level convincingly on the weekly chart, then the decline for the US dollar to the downside could actually accelerate, because we'll have a ABCD pattern formation, which will give us downside targets. Now, just to reiterate this, we have had a look at this chart in the past as well, but for the new subscribers, our long-term view is that the US dollar has stopped. And one of the reasons that we think is because of this market symmetry. So if you look at this going back to the early 90s, the US dollar topped around the July of 2001, and it made a double top formation here, and for the next several years it just went down. And this time we have had a rally. The US dollar has been rallying for approximately 12 years, but in earnest it started its bull run in around 2011. So approximately we are in that ballpark figure from a time perspective. And also, if you look at the move in terms of the projection, we actually completed an identical move in terms of number of points. So that's the market symmetry, which is also telling us that, okay, look, we have these two symmetries in place. The other reason was with 78.6% retracement, and of course this smaller blue pattern completing nearby. And now there is possibility, of course, the dollar could rally, because if you look at the formation around here, the market actually came pretty close to making new highs, but it did not happen. In fact, it turned into a double top formation. So that kind of scenario possibility always remains there till, in my opinion, this 61.8% retracement around the 99 level is broken to the downside. Okay, so we move on to the daily chart, and on the daily chart, just wanted to show you that this is something which we had been following for quite some time, and we have this box in gray as our target, and we in fact met that target today. The market went a little bit below, actually took these lows out, and now where it is basically right into this box. Now let's do a this had been our target for quite some time because of this black ABCD pattern right here. This is what we were looking at, because in our opinion 107 level is a pretty important top in the market, at least on the daily charts. So here we go. If we just do a retracement on all of this, let's see where the 78.6% retracement comes in. So there we go. So we are right between the 78 and 61.8% retracement. It's possible that around here the market could actually begin to find some sort of support come in. So perhaps some sort of bottoming process might take place. That possibility is there. If we just draw a trend line, let's see what sort of trend line we get. So yeah, it depends how you draw the trend line, with an overshoot or not. Around here, if we just take the bottom to the bottom, not to the through the bodies, regardless, we are in that ballpark zone where this market could in fact now find some support. Now let's take a look at the treasury markets. So we'll start by taking a look at the shorter end of the curve. This is a 2-year treasury note. And here we go. So long-time subscribers will know that we began to take a look at this market when we plotted this chart quite a few months ago, and we were of the opinion that in fact we are looking at a head and shoulder pattern and a smaller head and shoulder pattern around here. And in fact we charted this black ABCD pattern right here, which gave us a target of 3.9%. So we were prepared in advance, several months in advance, with a target of 3.9%, and we were just waiting for this 4.7% level to break, which was 38.2% retracement, and that just once it happened, that just confirmed that the market was in fact moving the CD leg lower, and lo and behold, we actually not only met that level, the market in fact exceeded that level, and it has closed pretty much right at 3.9%, which is 78.6% retracement. Now, and I'm going to remove this question mark because this scenario transpired. Now we have a fair amount of support around this level just by looking at the structure. Here we go. I'm going to just draw this red line around here and also around here, because that is a gap. So the markets sometimes like to go and probe and complete these gaps, maybe come to about 50% of this gap between low of the 24th of March and let's say the low of 4th of May. So maybe that possibility is there, but with this kind of a price action coming in on Monday, looks like the market or the yield, in other words, actually want to move higher now, but our pattern has been complete. Now that might just be a retracement move, and what we are going to do is we are going to draw a Fibonacci retracement of the CD leg, and we will go to the 38.2% retracement. That is going to be the first resistance level, and now we have some resistance from the structure around here as well close by. So around 4.2% or 4.15 to 4.2% is the kind of the region where the market is likely to move into, and that's where we could see a fair amount of resistance come in. Now how quickly the market will do that, we'll have to wait and see. What the significance is that if the market begins to move past this level, then we could have yields going fairly high, and recover quite a lot of this decline. That possibility is there. And if we were to draw the retracement from this level around here, there you go. So that's the kind of the zone we should really watch, because if the rally in yields is like to get into this box, and we'll be interested to see whether the yields will fill over there, or they will actually try to overcome this pretty strong resistance level and move higher. So really interesting juncture right here. And if we just zoom out, let me actually go out of it and into a weekly chart. What we can see is that we have actually come right towards the bottom of this range. If we just look at this whole thing as a trading range, then we have just come right at the bottom of this trading range, and it wouldn't be too much much of a surprise if the market actually retrace, maybe try to find a value region somewhere between the 38.2% and even 50% retracement of this entire range. That possibility is there. So fairly interesting scenario, but what it is telling us is that yields are likely to start moving higher, at least in the short term, and the 2-year treasury note is impacted. Now let's and this could also be part of the reason might actually be short covering as well. Now let's take a look at the 10-year treasury note. So let's take a look at ZN. Really interesting chart here, because the 10-year treasury note futures, they completed this ABCD pattern on the daily chart right at where we were expecting it to, because that's our 1-to-1 price projection ABCD at the 1.272 expansion of the BC swing. So we have a confluence of two things coming together. So that is not only it was a target, but now it turns into a pretty strong resistance level as well, and the market is likely to retrace from here. And this is what we have seen. The market actually went right to the tick, and actually pulled back about a point, which is pretty significant. Now if we just do a retracement of the entire CD leg, there is a possibility that retracement to around 112, which is about a couple of points below where the market is right now. So that possibility is there. Let me see if I don't see any further like any other patterns like ABCD right here. What we can try to do is try to find a region of confluence. So that is gonna be 50%, let's say, and then let's see if we draw a retracement from this swing low to this high. So we are getting a 50% for confluence around here. Let me actually get rid of the 38.2%, and also now the final one. Let's do it from here, and let's see what we get. 61, 70, 78 is gonna be pretty far away. So anywhere between 112.10 to 112, that's the kind of region this actually market could pull back into. So let's actually draw a possibility of having a swing like this. Let me try to give it a different color, and also put a question mark against it, because this is something which we are waiting on to happen, and maybe it happens. When it happens, we'll have to see. Now if we move on to the long bond futures, this is 30-year treasury note. Now the interesting thing to see is that slightly different pattern formation here, because the CD leg is still not complete, but in 10-year we were able to do that. But what is interesting to see is actually probed above the point B, So maybe it'll do a catch up, but with the 10-year, likely to move lower, it's going to have an impact on the 30-year long bond futures as well, which is really interesting because what the kind of scenario that I'm looking at is that okay, on the shorter end of the curve, which is 2-year, the yields are actually likely to move higher, also on the 10-year, but not so much on the 30-year because I'm expecting that okay, maybe yeah, let's see what sort of a move we can get around here as well. So yeah, this, I think the yield curve formation will be pretty interesting to watch for this. So let's do 30, yeah, 121. So this chart, 30-year long bond futures could actually also pull back, a a couple of points. That's possible. All right, so this is what the interest rate situation is. And now if we take a look at the gold market, because the gold market has been really strong. I've shown you that when we took a look at the dollar index chart, the dollar was pretty weak, in fact, but the gold, one would expect to have an inverse relationship because the gold here is being priced as the COMEX gold, the futures gold, to be actually stronger, but it's not. And this is something which we have discussed, that we are expecting this gold market to be sideways. So it's in a trading range. Maybe it can come back and try to test the bottom of the range one more time. That's also possible, but it still remains relatively strong. But one would have expected the gold to be quite high when the dollar was much lower, but it actually sold off. So this is actually an indication that what we are witnessing is a liquidation event. And what do I mean by that? So we have seen the stocks getting sold off. We have seen the yields moving lower. So in other words, the bonds moving higher, which could also be because of flight to quality. We have seen gold actually move lower. The crude oil was kind of mixed. Last week it was actually lower. So it looks like speculative players involved in the market. Maybe it has something to do with the margin calls, I do not know, but they are actually moving out of or closing their positions to maybe rotate into other positions or cover certain positions. Maybe they need the money to cover up some of the margin positions. I don't know exactly, but this is what I meant by the liquidation. Even when we see a number of asset classes actually being sold off altogether, and we see a flight into the US Treasuries, so flight to quality. Now, something very, very interesting, if we go and take a look at the Japanese yen. So we have actually spoken about the carry trade. So you can see that 11th of July, that's when the Bank of Japan, actually around this time frame, we do not know exactly, they actually did some pretty big intervention in the market. And then last week they raised their interest rates as well, which is kind of, when you think about it, opposite of what is going on in the West, because the ECB have actually lowered interest rates. The Bank of England did that past week, and the Fed is now likely to do that in their September meeting. And now some market participants actually are of the view that they should have already done that in this meeting, which happened in July. Maybe the Fed is actually behind the curve a little bit, so maybe we could expect to see a bigger rate cut, not just a quarter point. So the Japanese yen, this is the most really interesting thing what is happening because of the carry trade. The Japanese market, the stock market, has been under tremendous pressure. It actually sold off today as well. What we are witnessing here in this currency market, in the Japanese yen, that is actually a crash in the currency markets. Now, the currency markets, about 7 trillion dollars are traded on in volume on daily basis, where your USD is the highest volume pair, and after that is the US dollar and Japanese yen. So this is why what we saw, the kind of impact on the dollar index. yeah, we know that Japanese yen is where it is coming from. So what does it mean now? Let me actually take you to a really long-term chart, which we have actually looked at on the channel quite a few months ago. So this one is the monthly chart. I'm just going to zoom out. I'm just going to show you that why the level where the yen actually got to is pretty significant from a technical perspective. So if we just go back several years, several decades, going back to 1982, and we take that high and just draw a retracement to the lows, lows coming in around October 2011, roughly. That's when the US dollar actually in earnest started, around that time frame. And the bull market, the 38.2% retracement came around 152.70. Moving above this significantly would actually, make the yen a lot weaker. So that's one technical picture. The other one is that if we just look at these are the symmetry, this is the symmetry which exists in this market. These are the moves. When we have had moves of this much in magnitude, we have seen a strong selling come into the market. So here we had a perfect ABCD pattern right here, but the magnitudes were the same or nearly the same. So this is the market symmetry concept that we like to discuss on this channel. And now if we were to clone this and we bring it here, this is going back to 2011, then it comes right here pretty much to the level where the yen actually got to. So from a historic perspective, looking at the technical picture, this is a pretty weak yen position, which the Bank of Japan doesn't like to have, because it's just making things, the import of products produced, crude oil, for example, expensive and causing, inflationary pressures. So the Bank of Japan has been intervening in the markets, for quite a few months now, and in fact, when as far as increasing the interest rate. So that just shows how serious the central bank is with regards to actually supporting their currency. And then further, we actually have this ABCD, but it got extended. Initially, the ABCD was to this level, and we saw a few weeks, this is a monthly chart, few months where the yen actually pulled back, and we had a perfect ABCD very close to in fact, the market went right to the 38.2% retracement. But then we had a move, which in my opinion is a corrective move, where it went slightly above that, right to the, or very, very close to the 1.272 extension of this ABCD. So this was 121, and this is 1.272, and now we are seeing a fair amount of pullback coming into this market. It has broken this trend line, and in my opinion, it's got further to go to the downside, easily around 140, 139, and even possibly 133. So the 133 is coming because this is what happened back in 2015. Here we go, and we saw a decline in the Japanese yen became stronger. And then if you go back and look at the charts for the stocks actually also got sold off starting in August. In fact, there was a key timing which came around the in the week of 20th of August, based on memory, and we saw pretty sharp declines. And this time we had some timing coming a little bit earlier, and we have seen sharp declines. And then back in 2015 we had some another timing cycle come in September of 2015. We saw some sharp declines as well. So the correction that we are seeing in the US stock market, the chances are it's actually likely to last for a few more weeks. So especially in the NASDAQ index. We'll talk about it a little bit more later on. All right, so this is about the Japanese yen. So I'm not going to go into the details of the carry trade. I've shown you the technical picture. So this video is actually pretty technical. Some of you guys will actually enjoy it. Now let's take a look at. We'll now take a look at the stock market. So we'll start by taking a look at the NASDAQ, moving really quickly to the weekly. So the video which we did on last Sunday over the weekend review, we were initially looking at this formation around here with the 38.2% retracement for a possible bounce and a resistance right into it. And then we had a possible scenario in the shaded region right here, which is ABCD. And look, what the market did is actually it did not rally, but it did complete the kind of target that we were watching. So that's pretty interesting. Now the market is down about 17%. That's the biggest correction that we have seen right here. And this also tells me that what we are seeing is actually a completion of a cycle of a higher level, which means this correction could actually last for a few more weeks at least. We have a key timing coming in, which I'm going to show you on the daily chart for NASDAQ. That is for tomorrow. So there is a likelihood that we are going to see at least a bounce tomorrow. That possibility is there. So before we move into that, here is what the picture looks like now. So we have yesterday we were watching for this smaller ABC, this red one right here, right at the 38.2% retracement. This is why I was expecting at least a bounce to take place on Monday. But of course that did not happen, and what did in fact transpire is that now we have this ABCD completed this big blue one. So actually let me label it here. So that's A. Then we have our point B here, and this is gonna be our point C, and then we have the point D right here, which got completed today on the 5th of August. And the market actually went below the 38.2% right to the 50% level of the lows of October of 2023. So pretty interesting situation. And also the market was down by the as low as it went. It was really close to the minus 2 standard deviation levels, and that's kind of a move where the option sellers likely to come in and defend those kind of levels. And so we saw a market was sharply lower today, but then a lot of buying came into it, and it just recovered quite a lot, but not enough that we could see a positive candle. Now I'm just going to quickly move to the chart for the September contract, and here we go. We have this timing. So we had the timing come in yesterday. Excuse me, on the 5th of August, which is today. And here what we have seen is what might possibly be an interim kind of a low, which could actually produce at least a bounce. So timing is there. We'll wait and see what sort of price action comes our way tomorrow in the middle of the week. Another point to note is the price is right at this 200-day moving average on the September contract. Okay, now we'll just move to the SP500. We'll start to take a look at the cash index first. So you can see that this correction is way deeper now. So I'm just going to move it here. It's nearly 10%, which is fair amount. So yesterday we were watching for this ABCD completion, but of course that pattern didn't materialize. The market opened with a gap lower. It's right at the 78.6% retracement of the April lows, and it might actually be getting close to the maybe getting close to the 38.2% retracement of let me see. No, it's not quite there. Oh, yeah, it's pretty close to the 38.2% retracement of the October 2023 lows. I think we have got that on the weekly chart. So in my opinion, where the market is actually closed on the 5th of August is a pretty important support level. So we'll have to wait and see. I'm gonna remove this. Yeah, so another thing is that actually what we have is a ABCD, but it's like an extended formation that the CD leg CD leg actually got extended by 1.618 most likely. Yeah, there we go. So I'm gonna remove this. So what we have is a 1.618 around here, right at the 78.6% retracement. So in my opinion, that's a pretty important important support level. So with the timing coming in for the NASDAQ, I wouldn't be surprised to see that at least we get a bounce here, pretty much, you know, where we closed today. So really interesting formation. I'll clean up this chart a little bit. I'll remove some of these later on. So this is what we're expecting, at least a bounce. And here on the weekly chart for the S&P 500, one thing to note is look at this beautiful blue line around here, going back all the way to the March of 2020. The long-term support line is still intact. So, you know, we should keep should not lose our focus on that. Okay, so now let's actually bring this lower. Here we go. Okay, so here market is approaching or very close to the 38.2% retracement of the October 2023 lows. And then of course I showed you that pattern formation of ABCD, or the CD leg, was 1.618. And the other interesting thing to note is that the market went right to our target of 1.618 expansion of this entire BC swing of this black ABCD, which was the bear market of 2022. Now we do have some higher targets, but we might have to reevaluate those. So I'm gonna still leave those here, and we will evaluate the price action, whether this market will actually complete that or not. But the NASDAQ did. It's most likely to remain sideways to down, in my opinion. I will take a quick look at the ES, which is the S&P 500 futures. Here we saw again similar kind of pattern formation. This is the 2022 bear market, 1.618 expansion. The market has just been moving lower. This one actually came right to the 38.2% retracement of the October 2023 low. So it has done that, or it came very close to that, missing it by a few points in the futures market. And if we just take a look at this on the daily chart, so these standard deviation levels, these are from a previous the week, not the previous week. So I'm gonna delete those for now. So let's see whether we also have this extension of the CD leg in the futures. And there you go. So we have that 1.618 extension of the CD leg right here. So I'm actually gonna move it like this. So we could expect some sort of bounce, at least a bounce at this stage, to materialize, you know, just because where we are in terms of the pattern formations. So it has done, you know, going back to the October 2023. Let me draw the Fibonacci retracement. There you go, right at the 38.2% retracement. ABCD, we have confluence of 2. And you know, that's a pretty strong support level. So actually that's very, very interesting. Let me give it a different color. Okay, and let me actually draw it like this. So I'm doing it live with you guys. This is what I really enjoy doing. Here we go. So in my opinion, so that's gonna be your point X. That's your ABCD extended. it's a pretty strong level, at least for a bounce. Maybe we get more. So that's really, really interesting. Okay, so really quickly, I'm gonna show you the Dow Jones. So the Dow Jones actually broke this trend line, but it does appear to be a little bit stronger than some of the other indices. It looks like it has done the same thing, that where the CD leg might in fact be the yep, so it's done the 1.618. Here we go. So let me draw it like this. And I don't know what is the retracement level of this one. Probably it's right at the 78. I missed it. Yeah, it's between 78 and 61.8%. So yeah, that's also at key level. And of course, the most last but not least is the Russell 2000. The Russell 2000, look, it went right into the levels that we were watching for, and it's just been a really sharp decline in this one. I don't have a really clear ABCD pattern in the Russell, but on the weekly chart, what we can see is that it's just moved back into this range. Is roughly about 50%, I think. Yeah, it's done about a 50% move. So this is what we are looking at in the stock indices. I do apologize, a slightly longer video, but we covered a lot of things from a pure technical perspective. I hope you will like the video. If you enjoyed our technical analysis, please give it a thumbs up. And if you found the video of educational value, the way we like to do technical analysis here, then please do subscribe to the channel. And if you do, then please hit that bell icon button. That way you will know when the new videos are posted. So thank you very much for watching the video. Good luck, good trading, and we'll speak again soon.